Good day and welcome to another edition of our podcast. I am Dr.Suresh Rama, Head of Interest Rates and FX Strategy of RHB Bank. Dollar net short positions of 29.76 billion as of 19 February suggest the market is turning around in reducing the net short dollar positions. This is in line with our view of dollar strength that will continue in the first half of 2021, driven by a flight to safety, positioning turning to net long dollar from shorts, and an improvement in the US trade. We believe global risk sentiment will deteriorate significantly on a sustained basis from end February to early March onwards. We characterize the recent slight deterioration in global risk sentiment as we have only just begun. The technical turn around for the dollar index occurred in mid-January 2021, which had been our long-held view in terms of timing. We maintain our view that the dollar index will hit 93 in the first half of 2021. In the 10-year US Treasury yield space, we note the benchmark 10-year yield, which touched 1.33%, its highest level since February 27, 2020. Net long contracts on 10-year Treasury futures stands at 79,583 contracts as of 12 February. Long positions rose from 58,687 contracts at the end of January 2021, and bond yields have also picked up in tandem. In the euro-dollar space, we note the topside resistance is at 121.50. European Central Bank policymakers have expressed fresh concerns over the euro strength. Although the euro had not moved significantly in the preceding weeks, policymakers appeared keen to emphasize their concerns over the exchange rate as it threatened to lower the price of imports and make exports less competitive. Closer to home, we note Malaysia's final quarter GDP contracted by 3.4% year-on-year basis and by 0.3% quarter-over-quarter as full-year GDP contracted by 5.6%. A comparison of regional GDP in constant 2010 billion price shows Indonesia continuing to be the largest economy in the Southeast Asia region. Regional FX markets still show that the market is still short dollar against selected Asian currencies. The FX positioning of ringgit against the dollar is still short, indicating that the dollar rebound could induce a sharp reversal of the ringgit to weaken. We believe the ringgit is rather overvalued based on Reuters FX positioning as of 14 January, which shows the market is short dollar, and the 3-month onshore forward implied deposit interpolated from 3-month dollar ringgit FX forwards. The ringgit is roughly overvalued by 4.7% against the dollar. Current ringgit spot stands at 4.04, and our estimates suggest the currency should be trading around 423. The estimation is based on FX positioning against the dollar and 3-month dollar ringgit onshore forward implied deposit rate. We believe the ringgit midpoint stands at 4.0750. The currency is expected to trade on the weak side with 4.075 as the midpoint of 4.05 to 410. Any retrace below 4.05 will remain limited with good decent dollar buying from importers. Levels we expect importer orders to be filled in are at 4.045, 4.035 and at 4.03. The currency was topped out at just below 4.075 in its previous attempt. Another attempt is likely to be made to retest this level. A clear breach above 4.075 will see the pair testing 4.08 and will likely face trading stops that are lined up at just below 410. We hope you have enjoyed this podcast and thank you for listening.